Picture this. It is the chaotic month of September 2008, and the global financial world is about to witness an unprecedented catastrophe as a monumental 158-year-old banking institution collapses completely and irreversibly overnight, instantly vaporizing a staggering $600 billion into thin air. In the immediate fallout, meticulously built retirement accounts vanish as if they never existed, and millions of hardworking individuals suddenly lose their jobs in a rapidly escalating economic bloodbath. But what if I told you that the true root cause of this apocalyptic financial meltdown started with a lie so incredibly simple, so seemingly innocent, that you could effortlessly fit it onto a single roadside billboard? That lie, packaged as a rhetorical question, was simply this: why rent when you can own? To truly understand this catastrophe, cue the upbeat, optimistic music and transport yourself back to the year 2002. America is still nursing a massive economic hangover from the devastating dot-com crash, and the tragic events of September 11th have just sucker-punched the national economy, leaving Wall Street feeling incredibly twitchy, vulnerable, and desperate for a revival. But there is absolutely no need to worry, because the Federal Reserve has engineered a master plan to save the day. Their solution is to aggressively slash interest rates down to basically zero. Boom! Almost instantly, money becomes incredibly cheap, and borrowing cash becomes easier than anyone could have ever imagined. Suddenly, the beloved national pastime of the American public is no longer baseball. Instead, the ultimate national obsession becomes buying a house. Imagine walking into a lender's office and hearing, "Congratulations, you're officially approved for a $500,000 mortgage loan," even when you immediately confess that you only make a meager $40,000 a year. In this bizarre new reality, that is not a problem at all. The lenders simply introduce you to a buffet of dangerous financial instruments, adjustable rates, terrifying balloon payments, and the infamous ninja loan. Wait, what exactly is a ninja loan? It is an acronym that perfectly captures the absurdity of the era. No income, no job, no assets, and absolutely no problem for the bank. Back in the early 2000s, homeownership had evolved far beyond just having a practical roof and four sturdy walls to keep the rain out. It had become the ultimate manifestation of the American dream, symbolizing unparalleled stability, elevated social status, and pristine suburban bliss. The overwhelming message being pumped relentlessly through every single television ad, highway billboard, and enthusiastic mortgage seminar was loud, clear, and seductive. Why on earth would you rent when you can own? The major banks wholeheartedly agreed with this sentiment. In fact, they agreed so enthusiastically and aggressively that they essentially started throwing vast sums of money at ordinary people as if the entire economy were a giant, euphoric game show where absolutely everyone was a guaranteed winner. Enter the notorious subprime mortgage. Translation: these were high-risk loans specifically designed for people with remarkably bad credit histories, wildly unstable income streams, or even just a vague, confused idea of what money actually is, have bad credit, no credit at all, or currently reside in a dilapidated van down by the river. Congratulations, sir, you somehow qualify for a luxury multi-bedroom condo. When cautious borrowers asked, "Should I be worried about how I'm going to pay all this back?" the lenders smoothly replied, "Not your problem. If you happen to default, we will just seize the house, sell it for even more money, and everyone wins." This reckless mentality sparked a spectacular housing gold rush, a blinding frenzy where absolutely everyone was buying real estate. Consequently, housing prices skyrocketed into the stratosphere, and it became completely normal for your neighbor's house to miraculously double in value in a mere 6 months. Even part-time workers flipping burgers at McDonald's and local coffee shop baristas with a laughable $5 sitting in their savings accounts were being rubber-stamped and approved for massive mortgages. This was just another beautifully normal day in the roaring 2000s. The traditional rules of finance? Oh, those crucial regulations got launched straight out the nearest window. Traditional lending standards were deemed far too slow for this fast-paced market. Rigorous risk assessments were considered entirely too boring. Standard down payments became entirely optional. Simply put, if you possessed a beating pulse, you were virtually guaranteed a mortgage. People enthusiastically bought houses with the same casual frequency that college students buy ramen noodles, while lenders printed mortgage loans as if they were monopoly money. Mortgage brokers, operating on the front lines of this madness, raked in massive commissions faster than anyone could possibly whisper the word bubble. Behind all this deafening buzz and chaotic energy was a blind, unwavering faith that housing prices would simply always go up, mostly because they always had, until now. Beneath the welcoming open houses and the gleaming, freshly polished granite countertops, a dark and terrifying question quietly lingered in the shadows. What could possibly go wrong? Spoiler alert, absolutely everything. But the madness was just getting started. By the year 2005, buying a house was no longer about securing domestic stability or putting down familial roots. It was solely about flipping that property like a hot pancake and desperately hoping the very next buyer would gladly pay double the price. Real estate had completely shed its fundamental purpose as shelter. It had morphed into a giant speculative lottery ticket. People openly bragged about their absurd portfolios, claiming things like, "I teach phonics to children during the day, and I aggressively buy luxury condos at night. I just bought my third massive house with absolutely zero money down, and I don't even live in any of them." Or imagine a barista handing over a drink and saying, "Here is your latte. Sorry it took a minute. My bank just called and enthusiastically offered me another penthouse overlooking Miami." This behavior completely transcended traditional investing. It had become a full-blown national obsession defined by a simple greedy mantra: buy, flip, profit, repeat. And the mathematical reality was staggering. The more people enthusiastically joined in the frenzy, the higher the housing prices soared into the atmosphere. Simultaneously, the higher those prices soared, the more desperate people rushed headlong into the market. It was exactly like trying to put out a raging inferno by forcefully throwing buckets of high-octane gasoline directly at it. And the most terrifying part was that absolutely everyone in the country was gleefully holding a lit match. But beneath this red-hot, seemingly invincible exterior, deep structural rot was festering. Those subprime mortgages that everyone in the system was gluttonously gorging on, they were bad. Like historically, catastrophically, actually bad. They were characterized by exceptionally high risk, low to no documentation, and barely verified debt loads. However, the brilliant minds on Wall Street possessed a spectacular magic trick. They gathered all that toxic financial junk, bundled it tightly together into massive packages, slapped a shiny reassuring label on the front, and deceitfully sold it to global investors as entirely safe. Introducing the infamous mortgage-backed securities, now packed with 80% more blatant lies. How exactly do you make highly toxic, guaranteed-to-fail loans look as appealing and safe as solid gold? The answer is disturbingly easy. You simply pay the established credit ratings agencies to officially call them AAA, the highest possible safety rating. Even if a specific bundle is completely stuffed with the debts of bankrupt baristas and chronically unemployed gym bros, the agencies would look the other way and declare, "Ah, this seems all right." Here is the filthy, unethical part they deliberately omitted from the glossy investor brochures. The ratings agencies were being directly paid off by the very same massive banks whose products they were supposed to be objectively rating. It is the exact equivalent of hiring a prestigious food critic to review your restaurant and then blatantly telling them they will absolutely not get paid a single dime unless they publicly call your dangerously raw, salmonella-ridden chicken a Michelin-starred masterpiece. Behind heavily closed doors, the seasoned traders and Wall Street insiders knew perfectly well that these bundled assets were nothing more than a giant sack of absolute garbage. But the greedy chefs on Wall Street were nowhere near done cooking up trouble. They took those already shaky, volatile mortgage bundles and recklessly blended them into something even more absurdly complicated: collateralized debt obligations, commonly known as CDOs. Through this dark financial alchemy, horrific garbage loans magically transformed into pristine investment-grade assets that pension funds and sovereign wealth funds eagerly devoured. Actually, not absolutely everyone on the planet was fooled by this grand illusion. A tiny, isolated handful of skeptical investors, the oddballs, the outcasts, the troublemakers, actually bothered to sit down and read the incredibly dense, incredibly boring fine print of these massive financial contracts. They peered through the euphoria and saw the horrifying rot eating away inside the unprecedented boom. And instead of blindly buying in like the rest of the manic herd, they asked an incredibly bold, entirely unprecedented question: what if we actively bet against it? The immediate problem they faced was that there was literally no existing financial product in the world that allowed you to short the housing market. Undeterred, they boldly marched straight into Wall Street's intimidating marble-clad fortresses and bluntly declared, "These underlying loans are complete garbage. We want to explicitly short them. Can you please build us a customized instrument that pays us massively if these bonds go bust?" The wealthy bankers scoffed at the idea, mocking them by saying, "You want to bet against the American housing market? That's adorable." But they agreed anyway. "Fine. You want insurance? We will gladly write it for you. You pay us a hefty premium every single month. And when absolutely nothing happens because housing never goes down, we will happily pocket the premium. Everyone wins, but especially us. I mean, let's be real, it's not like the whole interconnected global financial system is going to magically collapse, right?" Wall Street, as always, smelled incredibly easy money. They did not believe the skeptics for a second, but they absolutely loved the brilliant idea of collecting steady, risk-free fees on something they arrogantly thought could simply never fail. So the quantitative analysts got to work and maliciously cooked up the exact financial weapon of mass destruction that would eventually blow up the entire world economy: credit default swaps. These were essentially unregulated insurance contracts that aggressively paid out if those specific mortgage-backed investments went bad and defaulted. The truly weird and entirely psychotic thing about this setup was that you didn't even have to actually own the underlying investment in order to buy the insurance on it. It was exactly like buying an incredibly lucrative life insurance policy on your elderly neighbor's grandma and then enthusiastically rooting for her to slip and fall down the stairs the very next morning. The entire global financial system had mutated into a towering, precarious Jenga tower, constructed entirely out of blatant lies and unprecedented, dizzying leverage. Every single wooden block at the base was a bad mortgage, and every single layer stacked on top was a bigger, far riskier synthetic bet. And at the very top of this teetering structure, executives clinked champagne glasses, cheering to yet another year of record-breaking multi-million-dollar bonuses. Who needs basic ethics or moral responsibility when easy, seemingly infinite money is flowing so freely? The desperate warnings of whistleblowers were completely ignored. The government regulators were quite literally dozing off at the wheel, and the incredibly powerful people in charge were simply too rich to care about the consequences and far too greedy to ever consider stopping. The lavish party raged on furiously, completely ignoring the fact that the floor was quietly cracking and splintering directly beneath their expensive leather shoes. At first, the impending doom was merely a soft whisper in the wind. A single missed mortgage payment here, a localized foreclosure over there, a massive luxury condo complex in Vegas quietly sitting empty with no buyers. But then the whisper swelled into an unstoppable, towering tsunami wave. And suddenly, the completely unthinkable scenario became the screaming headline across every major news network on the planet. Home prices are actually falling. Wait, housing always goes up, right? That is basic, undisputed economics. That is fundamentally not supposed to happen. For years, the seemingly invincible housing market had been a teetering Jenga tower comprised of lies, dangerous leverage, and wild, unchecked optimism. But in 2007, someone finally pulled the wrong block. The subprime loans, those incredibly risky, fundamentally rotten deals wrapped so beautifully in deceptive financial tinsel, finally started to implode en masse. And the intricate mortgage-backed securities that were built entirely on top of them. Yeah, those turned out to be literal ticking time bombs, and they finally exploded with catastrophic force. Giant banking conglomerates that had confidently stuffed their massive portfolios with what they genuinely believed were perfectly safe assets suddenly realized, in a state of sheer terror, that they were actually holding highly unstable radioactive garbage. Those pristine, highly coveted AAA-rated bundles were actually pure financial plutonium. The agonizing realization swept across trading floors. We literally cannot sell this junk to anyone, meaning we have to mark it to zero. But if we do that, that means, yeah, we are completely screwed. Uncontrollable panic spread across the globe like an apocalyptic wildfire. Elite hedge funds began bleeding cash at an unprecedented rate. Massive investment banks were forced into frantically slashing billions of dollars in horrifying losses from their pristine balance sheets. And then, boom. Lehman Brothers, a proud 158-year-old financial institution deeply embedded in the American fabric, was just gone. There was absolutely no government bailout for them, no heroic rescue at the 11th hour. There was just a smoking, radioactive $600 billion crater left smoking directly in the very middle of Wall Street. The terrifying message sent to the rest of the financial world was crystal clear. If an unshakable titan like Lehman can die so quickly, absolutely anyone can. Overnight, terrified banks completely and totally stopped lending money to each other. Global credit markets, the absolute lifeblood of the modern economy, froze as solid as a block of ice. It felt exactly as though someone had maliciously yanked the main power cord straight out of the wall of the global economy. When desperate businesses pleaded, "I desperately need a short-term loan just to make my payroll this week," the cold automated response from the banking sector was simply, "Sorry, there is absolutely no liquidity." When confused citizens asked, "What does that even mean?" the devastating translation was, "It means we are entirely closed. Good luck fending for yourselves." Absolutely everything jammed to a horrifying halt. Hard-working families suddenly couldn't secure mortgages to buy homes. Desperate businesses couldn't make payroll to pay their employees. Panicked investors couldn't cash out their life savings. Terrified retirees were forced to watch, completely helpless as their supposedly safe pensions evaporated into nothingness in real time. Once robust 401k accounts were absolutely toast. Entire lifetimes of careful savings were gone in a flash. The once thriving job market was completely vaporized. By the chaotic dark days of late 2008, the world was in full, undeniable collapse mode. Millions of people were unexpectedly unemployed. Foreclosure rates shot aggressively through the roof. Heartbreaking eviction notices were stacked on kitchen tables exactly like worthless junk mail. Soup kitchens, the vital, tragic places where basic food is desperately offered to hungry, displaced, and homeless people, could not remotely keep up with the staggering, unprecedented demand. Once quiet unemployment offices quickly morphed into chaotic, crowded spaces that looked exactly like disaster relief camps after a devastating hurricane. This horrifying reality proved that it wasn't just wealthy Wall Street burning to the ground. This was Main Street trapped in a terrifying, unmitigated freefall. And this catastrophic contagion absolutely did not stop politely at the U.S. border. In a matter of days, Iceland's major national banks collapsed entirely. Tokyo's massive stock markets plummeted violently into the abyss. Panicked European leaders scrambled frantically in late-night summits to formulate an emergency response. From the busy streets of London to the quiet avenues of Reykjavik, from neon-lit Tokyo to bustling São Paulo, global markets crashed in unison. Indestructible banks buckled under the unbearable pressure. Entire global economies spiraled violently, completely out of control. The terrifying question on everyone's lips was no longer, who is going to be the next to fail? The chilling realization was, is the entire global capitalist system fundamentally broken beyond repair? The brutal era known as the Great Recession had officially, undeniably begun. Faced with the absolute destruction of the modern world, the United States government found itself cornered with one truly impossible, incredibly toxic choice. Let the entire system burn to ashes or take billions of hard-earned taxpayer dollars and throw them directly at the very same greedy guys who gleefully lit the match in the first place. In October 2008, holding their noses, they chose to pick the latter option. The political request was staggering. I urgently need $700 billion. For what exactly? To frantically shovel into actively burning banks before this whole global thing violently explodes. Enter TARP, the incredibly controversial Troubled Asset Relief Program. Basically, the government was violently forced into giving Wall Street an absurdly luxurious $700 billion velvet pillow to softly fall on. Why? Because of the deeply infuriating concept that these reckless banks were simply too big to fail. The stark reality was that if the government let them rightfully collapse, their immense, interconnected weight would definitively drag down the entire global economy into a dark age. So the government did what it felt it absolutely had to do. They practically started chucking endless pallets of money out of helicopters. Seriously, the interventions were massive. Emergency loans, sweeping bailouts, and direct stock purchases. It didn't even matter what specific form the financial rescue took. If your massive corporate balance sheet had so much as a wisp of smoke coming out of it, Uncle Sam immediately rushed over and brought the infinite fire hose of taxpayer cash. But it wasn't just the massive banking conglomerates getting this golden VIP treatment. AIG, the monumental insurance giant that recklessly bet trillions of dollars on toxic garbage, somehow received over $180 billion in direct government aid. Even the traditional titans of American manufacturing like GM and Chrysler, the legendary car companies, got handed an astonishing $80 billion just to stay afloat. It was an unprecedented financial triage operation on a scale that absolutely no one had witnessed since the bleakest days of the Great Depression. Meanwhile, over at the Federal Reserve, Chairman Ben Bernanke was incredibly busy completely rewriting the established rules of traditional economics with a massive, unprecedented money cannon. Benchmark interest rates were mercilessly sliced all the way down to near zero. The fundamental cost of borrowing became basically completely free for major institutions. And then came the truly revolutionary, mind-bending intervention, quantitative easing. In layman's terms, this essentially means the Fed just started aggressively printing vast oceans of money entirely out of thin air, using it to eagerly buy up treasury bonds and all of that toxic mortgage junk clogging the system. Think of it as frantically trying to patch the gaping holes of the sinking Titanic with thick wads of freshly printed $100 bills. "Don't worry," the Fed essentially whispered. "Let me cook." And against all conventional logic, guess what? It kind of actually worked. Slowly, the terrified global markets began to calm down. The incredibly stressed banks finally unclenched their frozen balance sheets. The utterly decimated stock market finally bottomed out in the bleak month of March 2009 and started the long, agonizing crawl back toward normalcy. Wall Street, having stared death in the face, collectively exhaled a massive sigh of relief. But out in the real world, Main Street was still violently choking on the thick, toxic smoke left behind by Wall Street's raging inferno. The socioeconomic aftermath was incredibly, unforgivingly brutal. The national unemployment rate tragically hit a devastating 10%. A staggering 8 million perfectly good, stable jobs were permanently wiped from existence. An unimaginable 4 million beloved family homes were violently foreclosed upon by the very banks that had been saved. An eye-watering $19 trillion in generational household wealth completely and entirely vanished into the ether. Hard-working families that had absolutely never missed a single mortgage payment in their lives suddenly woke up to a nightmare, discovering they owed significantly more money on their homes than the actual physical homes were currently worth. And the general population? The people were absolutely, undeniably pissed off. "Wait, Wall Street bonuses are back already?" they screamed. "I literally just got evicted from my family home, and these bankers get a multi-million-dollar bonus." It was the ultimate sickening paradox of modern capitalism. The incredibly reckless people who directly caused the global collapse got bailed out with taxpayer money. Meanwhile, the completely innocent people who merely lived through the ensuing devastation got handed pink slips from their employers and humiliating food stamps just to survive. Wall Street gleefully popped expensive champagne on their balconies, while Main Street stood quietly in freezing lines just for a warm bowl of soup. And then, inevitably, came the righteous, boiling rage. Cut to the year 2011, in Zuccotti Park, nestled deep in the heart of New York City. Thousands upon thousands of furious citizens gather together, pitching small tents, beating loudly on makeshift drums, and holding up crudely written cardboard signs. One of those iconic signs boldly reads a slogan that would define a generation: "We are the 99%." This massive protest wasn't just about protesting the unfair bank bailouts anymore. It was a visceral, screaming indictment of an entire societal system that appeared rigged entirely to protect the elite and powerful. It was the ultimate disgusting realization of privatized profits during the boom, followed immediately by socialized losses during the bust, coupled with a completely total, terrifying absence of fundamental justice. Despite causing the greatest economic disaster in nearly a century, not a single major Wall Street CEO ever went to jail for their crimes. There were absolutely no handcuffs clinking, no humiliating perp walks broadcast on the nightly news. Instead, there were just incredibly lavish golden parachutes and quiet, unimaginably luxurious retirements in the Hamptons. The mechanical gears of the financial system ultimately survived the crisis, but the fundamental, foundational trust between the institutions and the public was burned completely and utterly to the ground. An entire new generation grew up with the cynical, deeply ingrained knowledge that when the giant banks catastrophically mess up, they get heroically rescued by the state. But when you, the ordinary citizen, mess up, you get completely and totally wrecked. Because if the terrifying events of 2008 taught us absolutely anything at all, it is the chilling reality that the very next devastating crisis won't ever look exactly like the last one. It will inevitably look perfectly harmless, incredibly profitable, and completely inevitable, right up until the terrifying moment that it isn't.